Is this really the everything rally, or is it kind of just the everything rally today?
I think people are so tired of the leadership last year that they've come out with this narrative that we need to broaden out the market, that we're going to have an everything rally. But not all of these stocks, not all these stories, not all of these narratives are created equal. And as much as I would like to see every part of the market rise without any pause, I still think we need to be really focused on cash flow generation, on whether or not people have confidence in the business model and the management team. And that's really going to drive, I think, enthusiasm and sentiment over the course of this year. So combined with earnings, which are still going to be a major focus for all fundamental investors, now that we don't have to worry as much about the Fed, and we know that we're on the path to policy easing, I just think the biggest winners are going to be the biggest growers, and we're not just going to broaden out for the sake of rotation.
Is that AI? Is that what you're saying?
It's hard not to love AI, but AI adjacent themes as well. You know, there are a lot of enablers in the software space. Obviously, we've taken a good look at a lot of the data centers and other companies and industries that kind of enable the AI revolution. And of course, we're focusing really hard on those companies that own the data in each of their industries, because they're going to be the winners. So it's not just a couple AI names, but I think it's a broader group of companies that are going to benefit from the significant technological disruption.
What about the big tech names that aren't as intimately involved in AI? And here I'm thinking about names like Apple or even Tesla, which has its own issues with having to cut prices of its vehicles. Is Apple worrisome in terms of the dominance of the Mag 7?
Look, here's what I would say. If you don't have a really compelling idiosyncratic story, which I would suggest Apple and Tesla may not have at this moment, you're not going to get a lot of investor attention. And no one wants to put dollars to work in things that don't have strong revenue growth prospects. And as I was saying, don't have the business models and the management teams that are gaining a lot of confidence. You know, I have to say, incremental money that we're putting to work now are in companies where we think the cash flow is going to continue to accelerate over the course of the year. And I'm not as confident that those are the names, those ones we just talked about, that should gain the investor attention.
What did you make of the DOJ coming after Apple? Like, is that an Apple story, you think, or does all tech need to worry? Like, what do you make of that?
It's a hard question, and I will say Europe usually leads a lot on the regulation side, particularly in technology.
Yeah.
So we think about kind of the focus on, you know, data privacy. We think about the focus on monopoly or anti-monopolistic behavior. And at this point, I'm not sure. I haven't studied enough the DOJ's commentary to say. What I will note is that whenever companies become dominant in their industry, they do get regulator attention. And Europe in particular, as I said, usually leads the charge there.
Well, Scar, we were talking about before we got on air that, like, at what point do the AI plays get so big that then that draws the attention from DC to them, for example?
That's a good question. Kate, how do you think about that?
Yeah, it is a very good question because, you know, we don't want to be so dependent on a single company. We've seen actually the government, like the U.S. government, do this a couple times. They will say, we're going to award a software license or a contract to a specific company and then realize that creates concentration risk for them. And I think they want to see other companies and other clients kind of do the same thing, which is to say, we're going to diversify across a number of different names. Actually, as an investor, that provides more opportunity. That means you don't just have to bank on the one winner in each part of the AI vertical, that you can own a couple different names that are all going to be geared in each part of the vertical.
Is it too early to worry about political disruption from the November election? If there's a new administration coming in, all the things that are in place right now could change on a dime.
Well, a lot of things could change on the time, Scarlett. You're totally right. And one of the things I worry most about in 2024 is that companies sometimes pull back on their capital expenditure in the second half of the year going into a big presidential election or a big potential change in leadership. But I would say more than just the presidential election, I'm really focused on the Congress. Like what happens in the Senate and the House, because those are the composition of those can really move the needle on legislation and on regulation and policy. So there's a lot to watch, and I think it's possible you see a little bit of a pause in enthusiasm as the election season heats up.
What is your strongest conviction right now?
I mean, outside of technology and the AI adjacent things. My strongest conviction is that the U.S. economy is in really good shape. I mean, we were never in the landing camp at all last year. We were kind of outliers in that camp. Maybe Goldman was also sort of in that space as well. But I think there is a good strength across a lot of different parts of the consumer that may be a little under-recognized. And as some of the input costs come down, we're like highly convicted in the disinflationary trends. You know, I think that's going to be good for margins across a whole bunch of the consumer. So I'm looking for opportunities there. We have a modest overweight to consumer discretionary in, specific areas and specific names. But I think that's going to be an area for us to add to risk.
What's the one thing you're worried about that you can't get out of your head, even though the signs are still pretty solid?
The one thing I'm very worried about, actually, is around politics and geopolitics. And as I mentioned, it has an impact on spending decisions. But of course, it's not just the U.S. elections. We have elections all around the world. There's a significant number of geopolitical risks, which may not, over the long term, affect the price direction of the market, but it can affect investment decisions. So I worry about that being a cooling force when everything else looks pretty good. Disinflation, monetary policy easing throughout some part of this year, the consumer in healthy shape, and this awesome shock and discontinuous change from technology. But if everyone gets a little bit worried, and CEOs and CFOs are people too, and it pulls back on spending, that could be an artificial pause to economic growth.